Imagine waking up to a financial earthquake so massive it shakes the world while you were sleeping. And the epicenter? Not Wall Street, not even Europe, but Japan. Yes, Japan's Norinchukin Bank, one of the largest institutional holders of U.S. debt, just pulled the trigger on a $63 billion sell-off, sending shockwaves through global markets. In a move that experts are calling unprecedented in scale, this is more than just numbers on a balance sheet. It's a signal that the tides of global finance are shifting beneath our feet. You might be wondering, why would a bank with deep, long-standing ties to U.S. Treasury securities make such a drastic move? And more importantly, what does this mean for the average investor, for the U.S. dollar, and for the global economy? By the end of this video, you'll not only understand the full story behind this historic dump, but also why it could ripple through markets in ways few anticipated and what it might mean for your financial future. To understand the gravity of this situation, we need to start with the basics. U.S. Treasury bonds are widely considered the safest financial instrument in the world. They are the backbone of global finance, a sort of gold standard for debt because they are backed by the full faith and credit of the United States government. Countries like Japan hold these bonds in staggering amounts as a way to stabilize their own economies, earn interest, and maintain liquidity. Norinchukin Bank, which serves Japan's agricultural cooperatives and has become one of the largest holders of U.S. debt, has been quietly accumulating these bonds for decades. The logic is simple, safe, predictable returns in a world that can be economically unpredictable. But $63 billion is not a small slice of the pie. It's a financial fireball capable of igniting major reactions in the markets. Now, let's put this number into perspective. As of recent reports, Japan held over $1.2 trillion in U.S. Treasury securities. That makes the $63 billion sale roughly 5% of Japan's total U.S. debt holdings. While 5 might sound manageable, in the financial universe of bonds, timing, perception, and scale matter far more than the percentage. Bond markets operate on confidence and supply-demand psychology. When a massive player like Norinchukin offloads such a significant amount in a short period, it's not just the immediate price that matters, it's the signal it sends to other investors. This sell-off can trigger a domino effect, prompting other holders to rethink their positions, which can drive yields up, bond prices down, and ripple into equities, commodities, and even currencies. The timing of this dump is also crucial. Global debt levels have been skyrocketing, interest rates are rising, and central banks around the world are tightening monetary policy. Investors are already jittery, trying to navigate the delicate balance between inflation, economic growth, and geopolitical tensions. Adding a sudden $63 billion injection of U.S. Treasury supply into the market is like opening a floodgate during a drought. Liquidity floods in, prices adjust, and the global perception of stability can wobble. Some analysts are calling this the largest wake-up call to U.S. debt markets in years. And when we talk about U.S. debt, we're talking about the instrument that essentially funds government spending, from defense to infrastructure, from social programs to debt interest itself. Any sign of weakening demand for treasuries is closely monitored because it can affect borrowing costs across the board, including for every American taxpayer. But why would Norinchukin take such a step now? Several factors seem to converge. First, Japan's domestic economic conditions have been under pressure for years. Inflation has been stubbornly low, wages stagnant, and the Bank of Japan has been maneuvering with a combination of quantitative easing and negative interest rates. In such an environment, holding massive amounts of low-yield U.S. Treasuries can become a drag on returns, especially when the yen is fluctuating. Second, global interest rates have been rising, meaning older, lower-yield bonds are losing market value compared to newer issues. This can create an incentive for large holders to sell before losses compound. Third, geopolitical dynamics, including tensions in Asia and shifts in trade relationships, can prompt strategic adjustments in foreign holdings. Essential. Why this $63 billion move may not be an emotional panic. It may be a calculated repositioning in anticipation of broader market changes. Now let's break down the immediate market implications. When a massive treasury holder sells in such quantity, bond prices fall and yields rise. For the average investor, higher yields on U.S. Treasuries sound like a positive because new bonds offer more return. However, rising yields can spook equity markets as borrowing costs for companies increase, potentially slowing corporate growth and squeezing profit margins. For the U.S. dollar, there's also a psychological dimension. A major sale can cause temporary volatility in forex markets as investors recalibrate their expectations. Precious metals, particularly gold and silver, often react inversely to U.S. debt turmoil. Historically, when bond markets wobble, investors flock to safe haven assets, driving prices higher. So, a savvy trader watching this move might consider gold or silver as a hedge against the uncertainty created by such a large Treasury sell-off. To give you a historical analogy, think back to 1994, when the U.S. Federal Reserve unexpectedly raised interest rates. Bond markets plunged, equities wobbled, and a global ripple ensued, affecting emerging markets and investors worldwide. The Norinchukin $63 billion dump is not identical, but it's a modern echo, a single massive action by a trusted institution that challenges market assumptions, reminding everyone that no market is immune from volatility. And in today's interconnected financial ecosystem, reactions are almost instantaneous. Traders on Wall Street, portfolio managers in London, and even individual investors watching from home feel the tremors almost in real time. Furthermore, this sale raises deeper questions about the stability of U.S. debt demand. Traditionally, countries like Japan, China, and major sovereign funds are considered stable buyers, the foundation upon which Treasury markets rely. When a major player like Norinchukin suddenly shifts, it forces analysts and investors alike to ask, if one major holder can move this decisively, could others follow? And if they do, what does that mean for interest rates, the dollar's value, and global liquidity? Some strategists warn that a cascading effect could emerge, though it's important to emphasize that the U.S. Treasury market is still massive and diversified. Nevertheless, perception drives financial behavior as much as fundamentals, and perception has been rattled. Equally important is understanding the human dimension. Behind the numbers are real decisions being made by fund managers, economists, and policymakers. They weigh risk, geopolitical signals, domestic pressures, and the expectations of millions of depositors. A $63 billion move doesn't happen in isolation. It's part of a web of strategic calculations, some visible, some hidden. And while the immediate headlines scream shock, the long-term narrative may point toward prudent financial management in an era of unprecedented uncertainty. It's a reminder that the world of high finance operates on both numbers and narrative, facts and psychology intertwined. In conclusion, the Norinchukin Bank's $63 billion Treasury dump is far more than a headline. It's a lens through which we can view the complexities of global finance. It illustrates how interconnected markets have become, how perception can amplify reality, and how even the most trusted instruments, like U.S. Treasuries, are subject to the dynamics of global strategy, timing, and confidence. Investors, policymakers, and everyday citizens alike should take note. The world of finance is shifting, and staying informed is no longer optional. It's essential. The implications ripple across bond yields, equities, currencies, and precious metals, setting the stage for reactions that may unfold over months, if not years. Norinchukin's move serves as both a warning and a lesson. In finance, timing, scale, and perception matter as much as fundamentals. And understanding these forces can be the difference between being swept along or staying ahead of the wave. Ahead, we need to explore what this massive $63 billion move by Norinchukin really tells us about the broader trends in U.S. debt and global finance, because understanding the context is key to grasping its full impact. Let's start with the sheer scale of U.S. Treasury markets. As of now, the total U.S. debt stands above $33 trillion, making it the largest sovereign debt market in the world. Governments, corporations, and individuals rely on the stability of these treasuries to manage risk, plan investments, and anchor their financial strategies. Historically, U.S. Treasuries have been considered virtually risk-free, earning them the nickname riskless assets. Yet, when a major holder like Norinchukin decides to sell tens of billions in a short period, it challenges the market's assumptions about that safety. Suddenly, the notion of risk becomes tangible, even in the seemingly rock-solid world of U.S. government debt. To break it down, imagine the bond market as a massive seesaw of supply and demand. When buyers like Norinchukin are steady, the seesaw remains balanced, keeping yields low and prices stable. But a sudden offload acts like a heavy hand pushing down on one side, causing yields to spike and prices to drop. And because treasuries are the benchmark for interest rates worldwide, any movement in U.S. yields doesn't stay in the bond market. It ripples out to mortgages, corporate borrowing costs, and even emerging market loans. For instance, if yields rise, it becomes more expensive for American companies to borrow money for expansion. That can slow hiring, dampen investment, and even indirectly affect consumer prices. At the same time, foreign investors may reassess their appetite for treasuries, which could influence currency markets, particularly the dollar and yen. The interconnectedness is almost like a tightly woven spiderweb. Disturb one strand, and the vibration travels throughout. Historical precedent adds an even more intriguing dimension. Japan itself has been one of the largest buyers of U.S. debt for decades, beginning in the post-World War II era, when rebuilding and stabilizing the yen were priorities. By holding U.S. Treasuries, Japan effectively locked in a safe, interest-bearing asset while maintaining influence over global finance. Other countries, particularly China, have mirrored this strategy, creating a network of trusted buyers whose stability underpins the Treasury market. However, shifts in these patterns, like Norinchukin's sudden sell-off, signal a recalibration of confidence. It's like watching a domino chain, where a piece that seemed immovable suddenly tips over. Economists and investors alike are now asking whether this is an isolated adjustment or part of a larger trend where major holders reconsider the role of U.S. debt in their portfolios. We also have to consider the timing within the global interest rate environment. Central banks around the world, including the Federal Reserve, have been raising rates to combat inflation, and these higher rates have made older bonds with lower yields less attractive. That's a key reason for this move. Norinchukin may be acting strategically to avoid losses on lower-yield treasuries before new, higher-yield debt becomes available. In simple terms, imagine buying a bond that pays 1% interest while new bonds now pay 5%. Holding the old bond locks in lower returns and creates an opportunity cost. Large institutional investors like Norinchukin are extremely sensitive to such calculations because even small percentage differences across billions of dollars translate into massive financial impact. Timing becomes everything, and in this case, the timing appears to be deliberate. Now, let's talk about market psychology, which is often overlooked but immensely powerful. Financial markets don't react solely to facts. They react to perceptions, expectations, and signals. When news breaks that a major bank sold $63 billion in treasuries, even if the move is fundamentally sound, it creates uncertainty. Traders, hedge funds, and individual investors might question, if they're selling, should we be worried? Are others going to follow? This uncertainty can drive volatility, even if the underlying fundamentals haven't changed dramatically. This is why markets sometimes overreact to news, creating opportunities for those who understand the mechanics of supply, demand, and sentiment. Precious metals, particularly gold and silver, are prime examples of how perception drives markets. Historically, when treasury markets wobble, investors flock to these metals as a hedge, pushing prices higher in what some call a flight to safety. In fact, right after reports of Norinchukin's move surfaced, gold and silver experienced noticeable upticks in trading volumes and price action, underscoring this principle. The geopolitical dimension is equally critical. Japan's financial decisions don't occur in a vacuum. They're shaped by regional dynamics, including tensions in East Asia, trade negotiations, and domestic economic pressures. By adjusting its U.S. Treasury holdings, Norinchukin may also be indirectly signaling a shift in strategic priorities, balancing domestic needs with global exposure. This adds another layer of complexity. Markets are now forced to interpret not just the financial data, but the political and strategic intentions behind it. Think of it as reading tea leaves, but the stakes are trillions of dollars. Every trader, economist, and policy advisor is asking the same question: is this a routine portfolio adjustment or a harbinger of deeper changes in global financial alignments? Now, let's bring this closer to everyday impact. While $63 billion is a number most people can't even fathom, the effects eventually trickle down. Higher treasury yields can influence mortgage rates, car loans, and corporate financing costs. Currency fluctuations might affect import prices, which can subtly impact groceries, electronics, and gas. Even retirement accounts and pensions, which often hold U.S. debt indirectly through funds and ETFs, can feel the ripple effects. In other words, a single massive move in an institutional portfolio, like Norinchukin's, demonstrates the invisible but pervasive connections between global finance and daily life. Financial literacy, therefore, becomes more than just knowing numbers. It's understanding cause and effect, risk and timing, perception and reality. Another interesting angle is the comparison to historical treasury sell-offs. In 2013, the taper tantrum, caused by hints of the Fed slowing its bond buying program, led to sharp jumps in yields and a wave of market volatility. While Norinchukin's move is different in that it's a private institutional action rather than a policy signal, the mechanics are similar. Sudden changes in large bond holdings stress test market assumptions and force recalibration. The key takeaway here is that while markets are deep and liquid, they are not immune to sudden shocks from major players. That's why analysts are watching whether this is a one-off event or a potential trend in how large foreign holders manage risk and returns. Finally, we need to consider the long-term implications for U.S. debt strategy. If major holders like Norinchukin begin to sell off portions of their portfolios more aggressively, it could prompt the U.S. Treasury to reconsider its debt issuance, auction strategies, and interest rate assumptions. Policymakers may need to factor in increased volatility and potential shifts in foreign demand. In practical terms, this could influence decisions on government spending, infrastructure programs, and even defense budgets. The ripple effect extends far beyond Wall Street. It reaches every corner of economic policy and financial planning. And for investors, understanding these dynamics is critical to navigating a world where even the safest assets can be subject to sudden, strategic adjustments. Adjustments like these don't just happen in isolation, they reflect a shifting landscape. And global finance, where risk, strategy, and timing collide. Norinchukin's $63 billion Treasury sell-off is a lens into a much larger story: the evolving behavior of major institutional investors, the fragility hidden beneath seemingly stable markets, and the subtle yet powerful interplay between perception and reality. Let's break this down further. First, consider the role of interest rates. When yields rise as a result of large-scale Treasury sales, it's not just bonds that react. Equities, commodities, and currencies all feel the pressure. Higher yields can draw money away from the stock market as investors seek safer, higher returns from Treasuries. At the same time, stronger yields can attract foreign capital, pushing the dollar higher, which then affects exports, corporate profits, and even emerging markets that rely on dollar-denominated debt. The ripple effect is enormous, and it's why a single institutional move like Norinchukin's can dominate headlines worldwide. To make this more relatable, imagine the global financial system as a vast, interconnected network of pipes carrying trillions of dollars. Most of the time, the flow is steady, predictable, and virtually unnoticed by the average observer. But when a major valve, like Norinchukin, opens suddenly, the flow intensifies, pressure rises, and the system adjusts. Some pipes bulge, some valves whine under stress, and those watching closely can anticipate where the next adjustments will occur. For example, gold and SAI. Elver often act as pressure release valves in times of bond market turbulence. When large investors sell treasuries, uncertainty rises, and these metals typically surge as investors seek tangible stores of value. It's classic market behavior, simple yet profound, illustrating how confidence, liquidity, and perception interact continuously. Digging deeper, we see that this move isn't just about bonds. It's about strategy, liquidity, and risk management on a colossal scale. Large institutions like Norinchukin manage portfolios with trillions of dollars in mind, balancing the need for safe returns with the imperative to remain nimble in volatile markets. A $63 billion adjustment might seem reckless to the casual observer, but in context it could be a prudent repositioning. When yields rise, older bonds lose relative value, so selling them and reallocating toward newer, higher-yielding instruments is a common strategy. The key difference here is scale and visibility. Few actions capture global attention like a single bank moving tens of billions of dollars, precisely because it tests assumptions about stability and confidence. From a historical perspective, this action recalls previous Treasury market shocks. The 1994 Fed rate hike and the 2013 taper tantrum both demonstrated how sudden adjustments in expectations can ripple across markets. Norinchukin's move is similar in effect, though driven by private institutional strategy rather than central bank policy. Yet the result is the same. Volatility spikes, prices adjust, and investors reassess risk. Understanding this pattern helps us frame Norinchukin's decision not as panic, but as calculated risk management. It's a reminder that in finance, context and timing are just as important as numbers themselves. Another critical element to examine is geopolitical context. Japan's financial strategy is influenced not just by domestic economics, but also by its position in global trade, regional security concerns, and currency policy. Adjusting Treasury holdings allows Japanese institutions to manage currency exposure, hedge against domestic uncertainties, and respond to global economic signals. In effect, Norinchukin's sale is as much about macroeconomic strategy as it is about returns. It's a sophisticated balancing act, managing risk while maintaining flexibility in an unpredictable global environment. Let's also consider the implications for U.S. debt management. Large-scale sales by trusted buyers raise questions about the demand structure for treasuries. While the U.S. Treasury market is deep, diversified, and highly liquid, perception matters. If investors worry about consistent demand from major holders, it could influence Treasury auction strategy, interest rate assumptions, and even fiscal policy decisions. Rising yields mean higher borrowing costs for the government, which then cascades into everything from infrastructure projects to social programs. Understanding this chain reaction underscores how interconnected global finance is, and why a single institutional adjustment resonates far beyond its immediate context. In practical terms for individual investors, the effects are tangible. Rising Treasury yields influence mortgage rates, car loans, and corporate financing. Equity markets may wobble as capital shifts towards safer returns. Precious metals often rally, providing hedges against uncertainty. Currencies fluctuate as foreign demand for dollars adjusts. Even retirement portfolios feel the impact indirectly through ETFs and bond funds. By observing these shifts, investors gain insight into the larger forces shaping the global economy and can make more informed decisions in response to market movements. Furthermore, this episode highlights a broader theme: the importance of perception in financial markets. Even when fundamentals remain solid, the belief that something significant is happening can move prices just as much as actual economic changes. Markets react not only to what is true, but to what participants believe is true. That's why transparency, timing, and communication are critical. Norinchukin's move illustrates how a single strategic adjustment can send a message, shape sentiment, and influence behavior across multiple asset classes. Investors, policymakers, and observers alike must be attuned to both the facts and the narratives that markets respond to. Finally, looking ahead, the Norinchukin sell-off may mark a subtle but important shift in global Treasury dynamics. Investors around the world will be watching carefully. Will other major holders adjust their positions in response? Will yields stabilize or continue to climb? How will us fiscal and monetary policy respond? While the immediate shock is headline-grabbing, the long-term implications are more about strategic recalibration and market psychology than panic. It's a reminder that in finance, foresight, analysis, and adaptability are critical to navigating uncertainty. Those who understand the mechanics of bond markets, interest rates, and investor behavior are better positioned to anticipate shifts rather than react to them. As this story unfolds, it becomes clear that Norinchukin's $63 billion move is not just an isolated headline. It's a window into the complex world of global finance where perception, strategy, and timing intersect with billions of dollars in play. By studying the event, investors gain insight into how major institutions think, how markets respond, and how interconnected the financial system truly is. Bonds, equities, currencies, and precious metals are all part of the same ecosystem, responding to signals that can come from half a world away. For anyone paying attention, this is a lesson in vigilance, strategy, and understanding the subtle dynamics that shape financial markets. In conclusion, Japan's Norinchukin Bank's $63 billion Treasury sell-off serves as a powerful reminder that global finance is a delicate ecosystem where strategy, timing, and perception can have massive ripple effects. From the immediate impact on bond yields, equities, and currencies, to the psychological signals sent to investors worldwide, this event highlights how even the safest assets can be subject to sudden strategic adjustments. Understanding the interplay between U.S. debt interest rates, precious metals, and global investor behavior provides clarity in a world often dominated by uncertainty. For individual investors and policymakers alike, the lesson is clear: stay informed, appreciate the forces at play behind the headlines, and recognize that every major move in the financial system carries implications far beyond the numbers. By following these insights, viewers can navigate markets with confidence, awareness, and foresight, turning moments of volatility into opportunities for understanding and strategic planning.